unless the Japanese machinery order figure due on Wednesday the 15th of May is going to float your boat, then it's going to be a pretty quiet week for macroeconomic news. The most important numbers on the domestic front will be the unemployment, employment and wage growth data for March. They're going to be released by the Office for National Statistics on Tuesday the 14th. Now just to remind you that for the February numbers, unemployment was just 3.9%, the lowest figure since January 1975. Employment was 76.1%, the joint highest figure since records began in the early 1970s. The key question then will be whether an apparently tight jobs market is turning into wage inflation or not. As we can see here, total pay growth for February, including bonuses, was 3.5% year on year to a national average for full-time weekly pay of £569. The good news is that increase beat the latest inflation number of 1.9%, using the Consumer Price Index as a benchmark for that. Now that looks like good news for consumers to me, as it puts more cash in their wallets and purses in real terms, and, intriguingly, it may be good news for the food and drug retailers and general retailers too, despite all of the gloomy commentary you will read about retail and the high street in particular. And in fairness, consumer confidence still seems pretty soggy according to the influential monthly GfK survey, as we can see here. But nevertheless, for all of that concern, those sectors have actually begun to perform quite well, and maybe accelerating wage growth is something to do with that. Now on the company front, we've a busy week of corporate news ahead of us, with a fifth of the FTSE 100 and a wide range of mid and small caps due to publish results, issue trading statements or host their annual shareholders meeting. Names to potentially note include British gas owners Centrica on Monday the 13th of May, Real Estate Investment Trust or REIT Land Securities, as well as DCC and online holiday specialist On the Beach on the 14th, another REIT, British Land, retailer Kingfisher, another travel agent TUI and bookmaker William Hill on the 15th, Burberry, 3i, National Grid and another travel agent Thomas Cook on the 16th, and then to round the week off, EasyJet, Sage and another REIT, Derwent London on Friday the 17th. For all of the interest though that little lot's likely to generate, the stock most capable of causing a fuss in the week ahead in my book is Vodafone, when it releases its full year results on Tuesday the 14th of May. The telecoms giant has been a terrible performer over the past 12 months. Its shares have fallen by a third, while the FTSE 100 has lost around 2% over the same time period. Vodafone's shares have been under the cosh, I guess, probably for three reasons. First, not everyone is convinced that last May's €18.4 billion acquisition of Liberty Global's cable networks in Germany and Eastern Europe was the right thing to do. Even if the deal boasted Vodafone's capability to supply mobile, fixed line, broadband and TV services, quad play in these markets, the purchase added to an already substantial net debt pile, over €30 billion, even excluding India. Second, competition has been hotting up in the Spanish, Italian and British mobile telecoms markets, potentially putting pressure on prices, margins and profits in what are three of Vodafone's four biggest markets. The other, by the way, is Germany. And third, Vodafone is having to acquire spectrum for 5G, fifth generation mobile services in auctions in all of its major markets. And at some stage, it's going to have to invest in 5G network equipment and capacity as well. It had to spend more than expected in the UK and Italy, and it's now getting involved in ongoing auctions in Germany, where the bidding is already from the four contenders well ahead of expectations at more than $5 billion in total. The worry is clearly cash requirements are going up, interest payments on debt, spectrum auctions and network spending, just as competition and pressure on profits is accelerating. It's a potentially pretty tricky combination. However, this is not to say that new boss Nick Reed, who took over from Vittorio Calaio last October, is sitting around doing nothing. Quite the opposite. Vodafone is looking to invest in new networks so it can offer better services, improve the customer experience as it puts it, with a goal of driving customer retention and revenues while lowering costs. In addition, Mr. Reed has made a particular point of targeting better returns from the company's infrastructure assets, such as its mobile network towers, which some analysts suggest he may look to even partially spin off. We've seen similar deals done in France recently. Vodafone has already made announcements about network sharing as well, notably in Spain, to try and lower future investment burdens in network equipment. All of these moves are designed to bolster cash flow, and it's cash flow that funds the all-important dividend, and more of that in a moment. Now, management has offered two main pieces of guidance for the full year that's about to end, so analysts will initially be looking at both of those. Vodafone has guided to growth in underlying adjusted profits of 3% against last year's figure of €14.7 billion, based on the metric of EBITDA, or earnings before interest, taxes, depreciation and amortisation. And Vodafone has also steered analysts towards free cash flow of at least €5.4 billion before spectrum costs. That then takes us to the dividend, which is now paid in euros. Why is this important? Well, Vodafone is the fifth highest yielding stock in the FTSE 100 for 2019, according to consensus analyst forecasts, with a yield of more than 9%. Vodafone has grown its annual shareholder distribution every year since, I think, 1998, as we can see in this final chart. But Nick Reed has already said this year's distribution will be unchanged at 15.07 euro cents. That ends the run. It could also mean a small drop in sterling terms once the pound's latest advance against the euro is taken into account. Now, some analysts think Mr. Reed will actually have to sanction a cut. Others assert he'll be able to protect the dividend by managing capital investment and maybe spinning off some of those infrastructure assets. So let's see who's right. Thank you for watching, and I look forward to seeing you next time.